Today, we'll take a closer look at Gold Royalty Corp. Ticker GROY, to determine if it's a buy at its current share price of $1.45. We'll analyze the management, strategy, assets, past growth, future prospects, and ultimately decide whether GROY fits into your portfolio. Gold Royalty Corporation is led by David Garofalo, a seasoned veteran in the mining industry. His background includes leadership roles at Goldcorp and Hudbay Minerals, with a focus on aggressive growth strategies. This aligns with GROY's primary objective, acquiring royalty and streaming interests in gold properties. Garofalo has pursued a growth-first strategy, which prioritizes acquiring royalties over near-term shareholder returns. While this approach can unlock long-term value, it hasn't always resonated with investors seeking immediate rewards. Despite not paying a dividend, the company has focused on expanding its royalty portfolio to build a pipeline of future income streams. GROY boasts a diversified portfolio of over 200 royalties, spanning across North America and key mining jurisdictions globally. The majority of these are in earlier stage exploration or development phases. While the pipeline is large, few projects have reached the production stage, which means revenue generation has been limited up to now. Significant assets include royalties in major mining projects like the Canadian Malartic Mine, one of the largest gold mines in Canada. As some of these assets transition into production, GROY stands to benefit from increased cash flows. The company has experienced rapid growth through acquisitions. This includes its purchase of Ely Gold Royalties and Abitibi Royalties, which added significant depth to its royalty portfolio. However, while assets have grown, revenue hasn't kept pace. The company's revenue stream remains modest, and costs associated with acquisitions have weighed on profitability. Looking ahead, GROY's growth prospects are tied to its ability to monetize its royalty interests as projects advance. A number of its royalties are poised to enter production in the coming years, providing potential for substantial revenue increases. Key milestones for these projects could trigger upward momentum for the stock, but this is not guaranteed in the short term. At a current share price of $1.45, GROY is down considerably from its highs above $5 in 2021. This steep decline reflects concerns about the delayed cash flow from its royalties and the lack of dividends. However, at this price point, GROY presents a speculative buy for investors with a higher risk tolerance. The company's valuation suggests it is trading at a discount relative to its future potential, especially if its pipeline comes online as expected. That said, investors should be cautious. While the growth pipeline is promising, there are risks, including delays in production timelines and the potential for continued shareholder dilution as the company seeks funding for further acquisitions. In summary, GROY is a speculative play with a solid management team and a strong growth pipeline. If you believe in the long-term potential of its royalty portfolio and are comfortable with the risks associated with delayed revenue and lack of dividends, it could be a buy at $1.45. However, for those seeking immediate returns or lower risk, you may want to wait for more clarity on the timing of cash flows from its assets.